All right, let's jump right into this explainer. We're going to uncover the hidden plumbing that literally funds humanity's biggest long-term dreams. To really understand the global economy, you have to imagine it as a massive, never-ending construction site. Everyone is building something. Countries are building highways, cities are building schools, and major companies are building factories. But here's the thing. These projects are incredibly expensive and take decades to finish. These builders don't just need a quick overnight loan. They need a stable, long-term relationship. And that brings us to the fascinating story of what we can call the global bond bazaar. Now, you hear about the stock market every single day on the news, right? But the real engine of the global economy is hidden in plain sight. It's a staggering $140 trillion bond bazaar. Bonds are basically just long-term debt obligations. When a corporation or a government needs to raise funds to support their massive operations, they issue a bond. And just to give you an idea of how incredibly fast this space has grown, the total U.S. bond market alone sat at about $6.2 trillion back in 1994. By our current estimates for 2025, that single domestic market will be pushing $55 trillion. The numbers are absolutely mind-blowing. And what's truly fascinating is the sheer scale of it all. Borrowing money through bonds actually completely dwarfs global stock ownership, simply because major projects require massive long-term lending relationships. Globally, we are looking at $140 trillion in bonds, compared to roughly $115 trillion in equities. Why the huge gap? Well, because bonds represent lending with a firm legal claim on assets. Equities, on the other hand, represent ownership, where you are strictly last in line if things go wrong. Most governments and corporations would honestly much rather borrow your money than sell off a piece of themselves, and investors really appreciate the safety net that a legal claim provides. So, if you're wondering who exactly is asking for all this cash, governments absolutely dominate the bazaar. They make up 55% of the global market, funding their deficits by issuing safe assets for investors. Corporate bonds make up another 35%, and securitized debt, which is essentially a bundle of consumer loans like your mortgages or auto loans, packaged together into a single tradable asset, holds the remaining 10%. Governments take the lion's share here simply because national debt reflects the historical accumulation of annual federal expenditures minus taxes over hundreds of years. They constantly need to finance those imbalances, and the bond market is their go-to tool to do it. And the undisputed giant of this bazaar? That's Uncle Sam. The U.S. government offers Treasury notes, which typically mature in anywhere from over 1 to 10 years, and Treasury bonds, which stretch past that 10-year mark to fund over $30 trillion of U.S. national debt. And here's the kicker. They do this with essentially zero default risk. Because Uncle Sam is backed by the full faith and credit of the U.S. government, meaning he has the ultimate power to tax citizens and print money, these securities are considered completely free of default risk. As an investor, you're accepting a relatively lower interest rate, paid out semi-annually, in exchange for that pristine, rock-solid safety. Next up, we have Mayor Muni. Wealthy investors absolutely love municipal bonds because they come with a literal superpower. The interest you earn is generally exempt from federal income taxes. These are securities issued by state and local governments to fund imbalances or finance long-term capital outlays. Think of a new toll bridge or a local high school. They generally fall into two categories. You've got general obligation bonds, backed by the city's power to tax, and revenue bonds, backed entirely by the cash flows from a specific project. Because of that amazing tax-free status, they offer a highly attractive tax-equivalent yield compared to standard corporate debt. Over on the private side, we have the corporate titans, massive companies like Apple or Ford. They pay higher yields to compensate you for being riskier than government bonds, but they are kept tightly in line by a strict legal contract known as a bond indenture. Because they aren't the government, they have to clearly spell out the rules of the loan. This indenture is filled with covenants. Covenants are essentially rules that restrict the company from taking on reckless amounts of new debt or draining their cash reserves. They're the critical guardrails that ensure bondholders actually get their money back. Now, not all investors want a full 30-year relationship. Some use a tool called strips to carve away the periodic interest payments and buy just the final principal payout as a zero-coupon bond. STRIPS stands for Separate Trading of Registered Interest and Principal Securities. It was created by the U.S. Treasury to standardize custom trading. Think of it like taking scissors to a traditional bond and literally cutting the semi-annual interest coupons right off the final face value payment. You buy that final payment at a steep discount today. You receive zero periodic interest along the way, but you get one massive face value check on the day it matures. It's a brilliant way for major institutions to perfectly match their future liabilities. But what about the silent thief of inflation? Well, Uncle Sam issues tips, which act as a brilliant shield by growing your principal exactly as inflation rates rise. Standard fixed principal bonds are heavily exposed to inflation. If the inflation thief steals 5% of your purchasing power, but your bond only pays 3%, you're literally losing money in real terms. But with TIPS, Treasury Inflation Protected Securities, the actual principal value of your bond adjusts upward every 6 months to match the consumer price index. Since your interest payment is a percentage of that ever-growing principal, your payouts increase right alongside it. It perfectly preserves your wealth. Trading these bonds mid-year reveals a really fascinating hidden mechanic. Because most bonds trade over-the-counter, meaning directly between dealer networks rather than on a public stock exchange, you don't actually just pay the quoted clean price. You pay what's called the dirty price. This compensates the seller for the exact number of days they held the bond. Let's say you decide to buy a bond 82 days after its last semi-annual interest payment. The previous owner technically earned 82 days worth of interest. The clean price is the mathematical base value of the bond itself, but the dirty price is the full amount you actually hand over at settlement, adding in that accrued interest to make the seller completely whole. Right in the center of the bazaar sit 3 judges: Moody's, S&P, and Fitch. They assign a specific letter grade to separate the safe borrowers from the highest risk ones. When you break down the grades, the best quality borrowers get an AAA or AAA reading, cementing them as top-tier investment grade. Medium-grade borrowers drop down to the BA or BBB tiers, but they still securely maintain their investment-grade status. However, if an issuer is highly leveraged and struggling, they fall into the speculative tier, getting a BA or BB rating and below. These are the famous junk bonds or high-yield bonds. And finally, if they hit a C or D rating, they are actively in default. That represents the absolute highest risk level in the entire market. So this brings us to a vital question. What exactly happens to the value of an old bond paying 3% when brand new ones suddenly start paying 5%? This right here is the fundamental, inescapable risk of bond trading. If you hold a fixed-rate bond and global interest rates go up, the market value of your bond immediately drops. Think about it. Nobody wants to buy your old 3% bond at full price when the newly issued bonds right next to it are yielding a much more attractive 5%. This exact seesaw effect is measured by a concept called duration, which proves that long-term bonds fall the hardest when interest rates rise. Duration is absolutely vital for portfolio management. It gives us an approximate mathematical rule. Your bond's percentage price change is roughly equal to its duration multiplied by the change in interest rates. So if interest rates jump by 1% and you're holding a 30-year bond with a duration of 10, the market value of your bond is going to drop by about 10%. The longer you lend your money out, the more sensitive you are to the shifting gravity of those interest rates. Traders also completely obsess over the yield curve, looking for the ultimate warning sign. Normally, if you lock your money up for 30 years, you demand a higher interest rate than if you lock it up for just 3 months. Makes sense. But occasionally, short-term yields spike higher than long-term yields. When short-term bonds start paying more than long-term bonds, the curve inverts. This is a classic historical warning of an impending economic recession. It essentially tells us that investors expect central banks to aggressively cut rates in the near future to save a failing economy, making it one of our most crucial macroeconomic indicators. Moving across the globe, the European bazaar treats the German bond as its gold standard, constantly measuring the spread or yield gap against riskier debt, like the Italian BTP, to monitor financial stability. In the euro area, you have a $25 trillion market made up of highly fragmented sovereign issuers. Because Germany is viewed as the safest economy there, its bund sets the baseline. Traders carefully track bonds like the Italian BTP against it. If the yield on Italian bonds suddenly skyrockets compared to Germany, that widening spread indicates severe market fear about Italy's risk of default. But the bazaar isn't just funding the past, it's actively funding the future through green bonds. This is a rapidly exploding $600 billion market dedicated to building the world's renewable energy and climate infrastructure. These are specific bonds issued globally by governments, the EU, and corporations, where the proceeds strictly finance environmentally sustainable projects. From practically nothing just a few years ago, issuance surged past $600 billion by 2024. So the next time you see a massive new wind farm, realize that it was very likely funded right here in the green bond market. Now we have to talk about the absolute biggest fish in the bazaar, the central banks. When you step back and look at the timeline of their interventions, it's wild.
During the 2008 global financial crisis, we saw the very first round of quantitative easing, as central banks bought up assets to save the system. In 2020, during the COVID pandemic, they stepped in again with trillion-dollar bond purchases to flood the market with liquidity and artificially lower yields. But by 2022, a massive global inflation shock forced an abrupt reversal. That led to aggressive rate hikes that ended the era of cheap money and sent existing bond prices plummeting.
And there's a fascinating contrast in how these central banks actually operate based on their mandates. The U.S. Federal Reserve primarily buys bonds of a single sovereign nation, U.S. Treasuries, which carries far less fragmentation risk. The European Central Bank, on the other hand, must buy bonds of multiple sovereign issuers: Germany, France, Italy, Spain, and more. Their mandate forces them to strictly manage the spreads between those nations to prevent fragmentation. That's a scenario where borrowing costs become so devastatingly high for weaker countries that it literally threatens to tear the Eurozone apart. Ultimately, whether you are building a green energy farm or a massive new bridge, the bond bazaar is where the world's long-term dreams are actually funded. From the safest U.S. Treasuries financing national deficits to high-yield corporate junk bonds keeping risky companies afloat, to local municipal bonds building community schools. Financial institutions hold the vast majority of these instruments, locking away trillions of dollars to quietly orchestrate global progress on a completely unimaginable scale. Leaving us all to wonder, in a world running on $140 trillion of debt, who really pulls the strings of human progress? Politicians pass the laws and announce the grand projects, sure, but the bond market dictates what they can actually afford to build. When traders demand higher yields, governments fall and corporate empires crumble. It's a pretty fascinating reality to ponder as you look at the hidden architecture of our world. Thanks for joining me on this explainer, and I hope you now see the global bond bazaar in a completely new light.